Hey everybody, good to be here today as we get to know Schwab.com a little bit better. Today I want to take you through using the Schwab.com platform to try and find some potential investment opportunities. We're going to kind of do a variation on a little bit of an unusual variation on a top-down analysis, but I think it's going to illustrate some of the tools that are available for you on Schwab.com. It's a powerful platform, and hopefully as you get to know it better, you'll be able to take advantage of that for your trading needs. Hey, my name is Brent Moores. I'm joined alongside Ms. Connie Hill, who's helping me out in the chat again. Thanks to Connie. She's a longtime friend of mine and colleague, and she has some wonderful classes. So make sure you follow her on X, formerly known as Twitter, at Connie Hill CS. My Twitter handle at Brent Moores CS. Good to see a few familiar names in the chat. And for those of you watching on a recording, great, we're glad to have you here too. Let me go through a few disclosures here before we get too far into this, and then we'll get to the heart of the matter. Information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart type. We'll be looking at individual stocks today, and they're not recommendations. Let's see, and just, realize there's risk to all trading, all stocks, and we'll find some stocks. Some may be dividend-paying stocks, but just because they're dividend-paying stocks doesn't mean that dividend is going to be continued, and they can stop paying dividends too. So, the normal risks there, everybody. Let's bring up the Schwab.com platform. And there we go. So here we go. Here's Schwab.com. So I mentioned kind of doing a top-down analysis, but we're not really going to do the normal traditional top-down analysis. But before we get to that, let me just mention a few things. One, make sure you subscribe to the Trader Talks channel. If you're on YouTube, bottom right portion of your page, you can subscribe so you don't miss future content there. What's top-down analysis? So a lot of you have probably heard that, and I'm not going to go too much into it because I'm kind of doing a variation of it. But the gist of it is this: is instead of looking at an individual stock and just saying, "Oh, I want to find XYZ stock," I want to find a stock that's in its strong sector. So we find something broad-based. Now you can say, look at the whole market. But really where I'm going to focus in is we can start with the sector, and we're going to find a stronger sector, and there's 11 sectors out there. And so we're going to just try and focus on that stronger sector. And then maybe we'll even go and find a strong industry group or subsector within that sector. So we're narrowing it down further. Industry. And then go down a little bit further, we can find the individual stock. So do you see the difference there? Instead of just saying, I want to find a stock that's growing at a 20% clip or something like that, which is, that's certainly a fine way to do it, or a stock that's trending up, that's fine. We may look for those things, but we're not going to start with that. We're first going to identify the strongest sector. There's 11 sectors out there. So what are the strong sectors? Well, we're going to see. So that's the traditional top-down analysis. Now I said I'm going to do kind of a variation on that, because the traditional way of doing top-down analysis is when we're trying to say, hey, let's find that strong sector. The approach to defining strength is what's the stock been doing? We get out of that. In other words, what's the sector been doing in terms of performance? So let me go here. Let me go to research, and I'm going to click on U.S. markets. Okay. Here's U.S. markets. We can see how the U.S. markets have done today, but I'm going to scroll down on this page a little bit. So this, by the way, there's just a lot of stuff on the Schwab platform. So scroll on down and look, scroll below the fold, so to speak, as I say. This is great info. I can see the 1-day, 5-day returns on various indexes, whatever. I'm going to scroll down. There's news. But really what I want to get to is this: sectors and industries. And so the traditional way that people look at this top-down analysis is they'll say, hey, look, here's my sectors. I'm going to find the top performing sector. But you got to be a little careful on that because I'm not going to necessarily do a one day, its default is 1 day, right? Maybe I'm looking at a different time frame. In this case, I'm going to look 30-day here. Or you can also zoom in. And the way to zoom in is you can just click on Show More. Click on Show More. And notice we're on Performance. And I can see that same thing, that 30-day or 1 month, essentially the same thing here on this, and I can see which sectors are stronger. That's the traditional way to do it. And then you can find the stronger industry groups, but ranked by performance in there as well. All right, so that's that. But that's not what we're going to do today. What we're going to do today is we're going to start kind of the same area, except we're going to locate something on this page that it's easy to miss. Valuation, okay? Valuation. What's that? So performance is all about like the stock performance, the technical analysis. And the in this case, one sec, let me just close something out in case that it looks like some people are having some technical issues there. So I'm going to close out my a little extra software program. And hopefully we're getting some our streaming back. But in our case, what I'm going to do is I'm going to go to valuation, this tab right here. Let's go to valuation. So here's valuation. And now instead of looking at just the technical, the price performance of the stock, what are we going to do? We're going to look at the fundamental, the financial performance of the stock. That's our goal there. Okay, the financial performance of the stock. And so we can view it different ways. Here's price to earnings, price to sales, dividend yield, PEG ratio. But what I'm going to do is here's my sectors. And on these sectors, I can see within each of these sectors, you can see the number of companies that are valued there. But what I'm going to do is I'm going to look, I want to focus on a couple areas here. One is I want to focus on the PE ratio. You guys are familiar with the PE ratio, aren't you? Well, a PE ratio is just taking the price of, on an individual company, it's the price of the stock divided by how much each share of that stock makes in earnings. Right? So that's a price to earnings ratio, PE ratio, and that's a very typical valuation measure. What we can do is we can take the price to earnings ratio for all the different stocks that make up that sector and kind of just average them. And that's going to give me an average PE for that sector. So that's our PE ratio. That's kind of a common one we're going to do. Typically, the traditional notion on PE ratios is lower is better. But I'm not just going to look at that PE. I also want to, because sometimes you can find a stock that's not doing very well. It's trading at a low PE because people don't expect the earnings to be very good. And we'll go to, I want to look at the PEG ratio as well. So that's taking that PE ratio. What we're looking at in that first column, we're taking the PE ratio, but we're going to compare it to the growth rate, the projected growth rate of the company. And therefore, you have a company that has a higher growth rate and something with kind of a high PE ratio, they kind of balance each other out. Similarly, if you get a company with a low PE ratio, but the growth rate is low, then it kind of equalizes things. So that PEG ratio is something I want to focus on today. The PEG ratio is a mixture of a value parameter and a growth parameter. And as you get closer to one, it's more and more of a value type company. Now, it doesn't need to be exactly, but even if it's a higher growth company, you can say, well, it doesn't seem like it's unreasonable if that PEG ratio is closer. So Rob's asking in the chat, I missed the path to the sector strength. Well, I'll show you here again on that in just 1 sec there, how to get there, so you don't have to watch the whole recording if you don't want to on that. But so this is where we're at. Remember, to get here, you can just go up to research. You can go to stocks. Excuse me, I clicked wrong. Research US markets. Scroll on down the page. here's this, and then just click show more. Okay, so here's where we are, and I clicked on valuation. Okay, I clicked on valuation. So that's what we're looking at. So I'm going to look at, so I'm kind of focusing on two areas here. I want to look at a PE ratio that's not ridiculously high. And you can see some are lower than others. Energy is pretty low on that. What's below 20? Financials is below 20. Just two are below 20 on that. Let's look at those PEG ratios there. Remember, that takes into account the growth rates. Above 2, that's less, a little less attractive than if we have this. So here's, I'm gonna focus on financials here for a sec, because that's got a nice little mix of a lower PE ratio and a lower PEG ratio. Okay, some have a little bit lower PE ratios, but their PEG ratios are higher, or vice versa. Right. So that's where I'm gonna stick with financials here. Now that we've found that stronger sector that we want, you can just click on financials and look what happens. When you click on one of the sectors, and it doesn't matter, you know, whatever parameters you use to decide what sector, when you click on the sector, it's going to then break it down into subsector or industries here: banks, capital markets, consumer finance, financial services, insurance, and so on. Okay. And again, you can see the same thing, and I'm going to click on valuation. And I'm going to use kind of those same things, those same parameters that I used before. I'm going to look at that PE ratio, and I'm going to look at that PEG ratio here. So I can look at these different sectors. Banks have a little bit lower of a PE ratio, right around 16. PEG ratio about 165. Okay, let's see. Consumer finance, about 15. PEG ratio, very low. That's strangely low almost there. Okay. Let's go to insurance. Insurance, PE ratio about 16. PEG ratio, again, relatively low. And you don't need to necessarily, when you're doing this, shoot for the lowest, you know, the lowest number on these. But, you know, this is kind of the approach you're going to do there if you kind of want to do this fundamental analysis top down, which is just kind of a different way of doing it. Let's click on insurance here, because that seems to rate fairly high. Look, when I click on insurance, it breaks it down further. It breaks that subsector down to particular industries, okay? Or sub-industries, I guess maybe is how we'd call it. Insurance brokers, life and health insurance, and so on. So you can keep on doing the same thing. I'm going to repeat the process. I'm going to click on valuation. And you don't have to stick with this. And maybe you're, you know, maybe you're looking for something that pays a little bit more of a dividend. Oh, well, there's a couple here: multi-line insurance, life insurance, both pay a dividend above 2%. So 2.5% life and health insurance. I'm going to click on that. And what are you going to see? We're going to see stocks that come up. Okay. So here we have stocks, and you may be familiar with some of these, and we can go through and we can see the performance on those. Again, we can look at the performance by the time frame. We can click on consensus. Now that we're actually on the individual stock level, we can look and see how different companies, how different analysts, rate a particular company. Now, I'm not going to go into the details here on this too much, but let me just mention this. Here's your consensus EPS. This is earnings per share consensus on the company. You can see ratings. You know, these are third-party ratings. These are not guarantees of future success or anything on there. So you can check out that consensus if you want. But I'm going to go back to valuation. You can do some of the same things we did before, but we can say, well, look, I want something that is maybe PE ratio reasonable and pays a dividend. Well, here's Aflac. That's one you've heard of. Okay, I think we've heard of that. We've probably, if you've seen a TV commercial or heard a radio advertisement, Aflac is pretty common out there. And we can scroll down and we can see these different companies and see which ones that are. Look, here's one, and I got to kind of scroll over. We have one more column here: dividend yield, PEG ratio. You can see that PEG ratio there. And sorry, I can't see the name of the company when I do all this, but I can go through here, a 2.5% yield on there. Okay, so there's MetLife. Okay, that's another one you guys have probably heard of. And then, like I was saying before, that's not the end of the road. Just because it looks good from the top down, just because the sector looks good or the industry looks good, doesn't mean the stock is good. We want to evaluate the individual stock. I'm going to click on MetLife here. And furthermore, what I'm going to do is I'm going to take MetLife and I want to compare it to some of its peers that may be alternatives. So if I go to MetLife and I scroll down, there's a section that says peer and ratio comparison, peers and ratios comparison. I'm going to go back here in just one sec, but just realize if I want to see more in-depth information on MetLife, I can do that. I can see that dividend. Okay? And if I want to see more on dividend, the dividend history and everything, and the dividend growth rates and whatnot, I can click on show more. I can see earnings, and if I want to see more on earnings and whatnot, and in depth, I can click on show more. In this peer and ratios comparison, what am I going to do? I'm going to click on show more. Okay? So here's, and I'm going to scroll down, and we're going to look at some of these companies. MetLife, Travelers, Aflac, Arthur Gallagher, Manulife. Okay, so here's, when you're looking at a company, I encourage you to compare the company to it could be, compare a company to its peers. It's easier, it's better to do that than to compare MetLife to, Microsoft or something like that. Completely different companies. Generally, we're going to compare one to another. You can look at things like analyst ratings, okay? Again, that's no guarantee. It's just one approach you can use on this. We can look at the dividend yields. 2.6%, that's for a dividend investor, that may be a reasonable dividend yield. If you're looking at, say, over here, 0.8%, that's not bad. In fact, a company's not bad if it doesn't even pay a dividend at all. And remember, when we talk about dividends, dividends can be discontinued. But if you are specifically desiring a dividend, a 0.8% dividend may not cut it, right? Because that's not much in the way of a dividend. Okay. Now, remember, in terms of a company and their performance, it's not just the dividend. The good dividend doesn't do you much good if the stock price just crashes. So you got to be careful on that, but that's the kind of thing we may look at. Other areas we may look at here, though. We may look at, let me scroll down just a little bit here. Again, we're comparing MetLife, which is what we came up with. Oops. I don't know how that got so thick here. Okay, MetLife, which is right there, to its peers. Because this is the industry group that we wanted to focus on. This is the financially stronger industry group, as measured by PE ratios, as measured by PEG ratios. There's other things to look at, like debt ratios, a little bit higher there. Like if we were to focus Aflac, here's Aflac, and here MetLife, MetLife has a lot more debt, higher debt ratio right now. Profit margins, here's my profit margin. Aflac has a much higher net profit margin, which is generally perceived to be a good thing. Let me go here. Our return on assets. Generally, higher is better. Most of these, higher is probably better. Probably not in the area of debt, but most of these areas people like to see higher. Return on assets, relatively low. Much higher on Aflac. Okay, we're still within the same group that we decided we liked, but one is, but we're comparing individual companies within that group. PE ratios, Aflac's lower. Okay, Now, projected earnings, price to forecast earnings, it's cheaper. MetLife is cheaper in that regard there. So we can compare in those realms there. Now, let me just keep on scrolling down. You can see ratings. You can go through, there's different ratings companies. There's third parties. Third party, they get it wrong sometimes. So just because it has a good rating doesn't mean you're going to be successful with that. But you can go through and compare these. It does seem, though, if I want to emphasize dividend, MetLife may be pays a higher dividend than Aflac, but in a lot of these other areas, Aflac may be a better, the better choice perhaps. Let me click on Aflac here. So I'm going to pull up Aflac, and let's look at this individual company. We've already done the peer comparison, and I just want to take you down here to dividends. Let's show their dividend history. So here's the history of dividends, and for a lot of investors, they like to see an increasing history year over year of dividends. It doesn't guarantee the results, future results. It doesn't guarantee future dividends. But for a lot of traders, that gives them confidence here on that. So not a terrible, looking dividend history, even though the dividend's not huge, about 1.8%. That's not minuscule either. Earnings, we can do the same thing. We can show more and go down, and that's one way to do it, okay? And if you want more in-depth details, go to your financial statements right down here, okay? So let's go and let's do the process again, but do it a slightly different way this time, okay? I'm going to do the same process, but I'm going to look for some different parameters this time. So I'm going to go to research. I'm going to go to US markets. I'm going to scroll down here, and I'm going to start off. Let me show more. I'm going to start off with this performance, and I just kind of want to look at the last month performance and see. We can sort by it. Click on the 1 month, and let me click on it again, and it'll sort it again. And we can see our top rated in terms of performance here is information technology. Okay, so in terms of valuation measures, probably not going to hold up as well as it's probably the valuation measures are probably not going to be as cheap or inexpensive as certain other industries. Just because it's IT, we'll have to wait and see. But the last month, it's been quite strong, up almost 4% over the past month. Let's go to valuation here. Okay. And I'm going to go here, and let's go to that. Remember I said that PEG ratio compares not just the PE ratio. I mean, the PE ratio is pretty high on IT. It's not the highest. Healthcare is higher, real estate's higher, but when you factor in the growth, compare real estate to information technology. It's significantly cheaper in terms of a PEG ratio, information technology, even though the PE ratio is about the same, okay? So there we go. Let me go back, and so I'm gonna follow the path for information technology. Remember, look, actually, industrials has a much lower PE ratio, but the PEG ratio is actually higher. Okay, energy had that very low PE ratio. That PEG ratio is significantly higher. So for this example, I want to stick with information technology. And I'm going to pull up information technology, and here we go. Here's information technology. Let me go to valuation measures. I'm going to stick over here, and I'm going to look at our PEG ratio. We're going to stick with that PEG ratio. Semiconductors, okay? And we're going to do the same thing. And semiconductors. Interesting, semiconductors, which are like huge in the news. You hear about them all the time. I actually have a relatively low PEG ratio. It's probably not from its valuation. Look, PE ratio 66. By most measures, that's a pretty high PE ratio, folks. But when you factor in, like this PEG ratio of near 1 means that, yeah, our PE ratio may be 66, but it also means that the growth rate is probably about 60. The projected growth rate is about 60% in that case. Do you see how I did that? That's about 110. This is about 1.1, my ratio there. Okay? So there we go. That's so let's stick with semiconductors, and we're probably going to see some names that we're familiar with here on semiconductors. So let me get out of there. Let me click on semiconductors, and here we go. Now, instead of going through each individually here, and what I'm going to do is I'm going to take some, and I'm going to check the ones that I want to look at and compare this time. So here I'm going to click on AMD. That's a big player. If you don't know, look at the market cap column. $247 billion company. That's a big company. Okay, that's AMD. Okay, let's go to some others that maybe we'll be familiar with. Broadcom, $810 billion company. That's not that far from $1 trillion company, folks. And for those of you, I apologize. I know on the live stream we're having a few streaming issues. It seems like there's some YouTube issues right now. I do apologize for that. Obviously, they're out of my control. If you do come back, I encourage you, this should be posted, but unless the tech issues keep this from being posted, which I doubt. Come back and watch later, and I'll go through it, and maybe you'll have a smoother stream. But if you are able to put up with the stream, I appreciate you sticking around here. Broadcom's, I mean, we're not that far from $1 trillion company. I'm going to check that one. So I'm going to selectively check the ones I can. I can check up to 5 on this comparison view here. I'm going to go down. Let's go to Micron. How about Micron? Another 116 billion. That one really comes to mind. It's obviously a big company. It's also one that has a pretty big local plant to me here. So that always comes to my mind here. NVIDIA, there's probably not a more talked about stock in the world than NVIDIA. Almost $3.5 trillion company. Crazy. It wasn't that long ago. How long ago was it when we were talking about the first $1 trillion company? It was 3 years ago. Now we have a $3.5 trillion company there. Let's do maybe one more. You can go, we'll go to the next page here. And there's Taiwan Semiconductors, Texas Instruments. I'll do Taiwan Semiconductor. It's $1 trillion company. I didn't know that was $1 trillion company. Click on check. And then when I want to compare these, I can click, there's a compare button. Where's the compare button? There it is, compare up to 5. Clicked on that. And now, in these nice, neat columns, first of all, I can see the price comparison of these. And to try and figure out the price comparison, you see the lines, they're color-coded. So you can see this kind of light blue. You got to match that. There's TSM, right? Light blue is TSM. There's the black, and you can do each of these this way, okay? And the dashed line, by the way, is that that's the S&P 500. Okay? This is, what's our time frame? Our time frame is 6 months here. You can change the time frame and see, and if you're interested in more of a technical analysis, you can look. Here we go. That's, you can look for trends there, but I'm not going to do that right now. You can even zoom in. Let's go to 3 months and get a slightly different view there on how these are doing. But the point is, I want to go down here to where we're comparing one company to another. These are all at least $100 billion companies. I think all of them were. Let's see, do I have a market cap here? I don't see a market cap here, but I think these are all big companies. They're all semiconductors. You can see your ratings on there. You can see your profit margins. We're comparing apples to apples here, all semiconductor companies. Now, they may focus on different things semiconductor-wise, but that's, this is the general group. NVIDIA, 55% profit margin. Taiwan Semi, 39% net margin. What net margin is just how much money you're making per, as compared to the money you're bringing in. In other words, you bring in, say, $100 billion and you make $100 million on that $100 billion. Or say you make $1 billion. You earn $1 billion on the $100 billion revenue. That'd be a 1% margin. Okay, not great, right? But some industries are lower. Walmart is never going to have, I don't think, a 55% profit margin. Grocery stores don't have that, or a 39% margin. They run much tighter margins. That's just the nature of the business. These guys, not so much. Debt ratios, that's pretty low. AVGO, not so much. Broadcom has a higher debt ratio, but 14%, 22%, that, for most investors, that's not a huge concern, to be very honest there. Return on assets, it seems like NVIDIA kind of just sticks out like a sore thumb here. I guess in a good way. I don't know, sore thumb makes it sound bad. But look at the numbers here on this. That's why it's so highly valued. Now, it's more highly priced too, okay? I think when we look at our PE ratio, well, maybe not in terms of price to earnings last 12 months. It's still, it's lower than others. By most measures, 65 isn't low, but remember, we got to compare it. Here's our PEG ratio, okay? That PEG ratio, not bad. That's actually doesn't seem unreasonable there. So this is an approach to finding your stocks. Instead of just, doing a screener, which is fine. We do screeners in this class. But if you want to find companies and use kind of this top-down approach, this is a way of doing it. Instead of looking for top-down the traditional way, use it this way. Let's take a deeper dive into NVIDIA here. This, I know, is a popular company. You can see your analyst ratings here and see what analysts think. And if you want to click on individual reports there, you can click on individual reports. You can check out the short interest on it. Percentage of shares outstanding, 1% is short. That means 1% of investors are basically taking a negative bet. They're trading in anticipation of the company falling. 1%, that's a relatively low number, actually. That's not too bad. There. Start to get closer to 10%, that'd be much more problematic on that. Let's go and check out dividends. They actually are paying a little dividend, 1 penny. Insignificant. I'm going to consider this the same as if it doesn't pay a dividend there with that low a dividend. Let's look at our earnings here. This is upcoming earnings. How do we know upcoming earnings? We don't. They're estimated earnings. Next one comes on November 20th. The consensus estimate is 74 cents for Q3 here. Yeah, Bridget's saying, wonder what Intel's short interest is in the chat. That's a good question. I don't know. You can look at it, you can find out and see. I suspect, I'd be surprised. And you know what? I'm wrong. Sometimes I'm wrong, folks. I'd be surprised if it's as low as 1% though, okay? Look at, just for your own interest. Look at stocks like GameStop, GME. See what their short interest is, or AMC. See what its short interest is. It's going to be a lot higher here. So that's expected earnings. Historical earnings, you can see that. I know it's not going to forever grow at the same clip that it's grown. We beat quarter after quarter on this. In other words, the actual earnings came in above the estimated earnings there. So let me click on show more here for our earnings so we can get a little bit bigger view here on this. Here's our annual earnings, and this projects it out into the future. So this one, the reason this one isn't filled in is it's an estimate, okay? But you can see estimated to go up year-over-year growth. Oh, that's revenue numbers. Excuse me, that's revenue. I said earnings. That's revenue numbers. Revenue growth rate over the past year, almost 200%. That's huge. Growth rates in GAAP earnings over the past year, up over 400%. Annualized, 51%. Let's keep going down. You can look for cash flow. A lot of traders like to see that higher cash flow. Let's go back here. And let's go down to our, I'm going to scroll down to our income, our financial statements here. Okay, balance sheet. What we like to see typically on our balance sheet is growth. This is the older data. This is the newer data. We like to see it be going up in most areas. In terms of current assets, we like that to be going up. Is that going? Yeah, it's been going up. A little dip in 2023. Total assets, we like that to be going up each year. Total liabilities, we actually would not like that to be going up each year, but it's surprising with the amount of growth. Actually, that's not actually that discouraging probably. It's expected. To a certain extent, you're going to usually probably see some debt and liability growth on a company that's growing as much as it is. So that isn't necessarily a deal killer just because liabilities and debt are going up. So Connie looked it up, about 2.7%. I'm actually surprised it's that low given all the negative press they've had. Intel has been kind of a, oh boy, they've had a couple terrible years, to be honest, on there. Okay, so that's balance sheet. Click on income statement. Now, those of you who are familiar with this are looking at this and going, well, that wasn't a full balance sheet. That's not a full income statement. You're correct. If you want to see the full deal and not just kind of the highlights of them, you click on show more there on that. Cash flow statement. We're going to be focused on the cash flow statement, cash from operations, okay? We like to see cash from operations go up, which we can see they are. So that's kind of a fairly positive view on those areas. Let's look at the valuation. Okay, I want to focus on this valuation here for a sec. P/E ratio is 65. Price to sales ratio is 35. That's going to be higher than most of the market. Yield is insignificant. Price to tangible book is very, very high. Now, that's not the end of the world because a lot of their stuff is more like intellectual property, which is driving the price of that. And our PEG ratio is a little bit lower. Let me go to show more. Let's just scroll down and do one more thing, then we'll wrap it up here. I want to go down to financial strength here. Current ratio, that's a measure of a company's current assets. That is, the cash is basically available within the next year for the company. Something that's liquidatable to cash will be converted to cash in the next year. That's your current assets divided by your current liabilities. 4 is actually a fairly high number. That's a positive thing. I don't think many people think NVIDIA is going to be going into, running out of cash here anytime soon. Could happen, I never know. Quick ratio, a lot of traders like to see that at maybe 1 or more. Here we're well over that. Debt is, debt's there. And we can look at, you can look at your balance sheet for debt over time. Obviously, it's going to change over time. But there we go. And our debt to equity is not that super high either. Okay. So that's just an example. My point here isn't, I'm not trying to, this is an example. This is not a sales pitch to buy any individual company. This could vary, there's pros and cons. You're paying a lot for NVIDIA for future expectations. Right now, they appear to be the market leader in terms of semiconductors, but that can be a very tenuous position, the whole market leader thing. Bringing up another stock that was a market leader in semiconductors for probably decades, Intel, which was brought up in the chat, you can see what's happened to them. So just because you're king of the hill right now doesn't mean that's going to continue. But if you're trying to find companies, you may consider going the process we did. You go to research, go to US markets, scroll on down to your sectors, and then you can go to valuation. You can find those sectors that meet the characteristics, the criteria that you're looking for in the sector, and then narrow it down to the individual stock there. So that's we'll call that an unconventional top-down approach, focusing primarily on that PEG ratio we used to try and find some potential companies. And there you go, folks. Thank you very much for joining me today. Thanks, Connie. Sorry for those tech issues, folks. Hopefully the recording is a lot more clean than the live session. But thanks for helping me out, Connie. Thanks to each of you for joining me today. And that's the last webcast of the day, but we'll see you tomorrow. In the meantime, have a great rest of the day, and we'll also see you same time next week. Bye-bye, everybody.